October 24, 1929, 9:32 a.m., New York City. The doors of the New York Stock Exchange slam open with a hollow metallic echo, one that seems to vibrate through the marble floors and the cold morning air. A thin fog hangs over Wall Street. The smell of sweat, ink, and frantic human breath fills the trading pit before the clocks have even finished ticking into the day. A clerk shouts a number no one believes. Another man drops his telephone as if it has suddenly burned his hand. And in less than 90 seconds, the world's most powerful financial empire begins to crumble. Men in dark wool coats stare at the ticker tape spinning out of its machine like a severed artery, bleeding prices that make no sense. Shares that were worth a lifetime of savings only days ago are now collapsing faster than anyone can shout their orders. Someone yells, "Sell everything." Another voice cracks, "It's the end. It's all gone." The panic spreads like fire through a dry forest. This moment, this quiet, brutal morning where fortunes evaporate before coffee is poured, is where our story begins. Because in the shadow of that collapse, when markets fell 89%, when banks failed and factories closed and families stood in breadlines stretching for blocks, a handful of positions didn't die. While everything else broke, 3 simple, almost boring positions quietly endured. The same 3 that would reappear in every crisis that followed. The same 3 that survived 1970s inflation, the 2008 implosion, the 2020 pandemic shock, and the 2022 bear market. The same 3 that survived the worst the world ever threw at money. But how? And why them? To answer that, we need to move slowly through time, through the smoke-filled rooms where decisions were made, through the minds of the architects who built the systems we still live under, and through the repeated pattern that history refuses to break. Because every crisis, no matter how different it appears on the surface, follows a rhythm. And these 3 positions, cash, gold, and the S&P 500, stand not because they escape risk, but because they occupy the 3 conditions of human economic reality: deflation, inflation, and long-term growth. But before we explore the mechanism behind each, we return to the world of 1929. In the aftermath of the crash, America descends into a cold silence. Banks shut their doors. Savings vanish. Prices fall year after year. But in the chaos, a different kind of figure walks the streets: the contrarian. Men like Bernard Baruch, who refused to join the frenzy and kept reserves of cash, while others stretched to the edge of leverage. As factories shut down, he quietly deployed money into assets the country had abandoned, and within a few years came out richer than before. Cash, the simplest asset of all, had become king. But something else was happening in the back rooms of Washington. President Franklin D. Roosevelt was preparing a decision that would change the course of financial history: the confiscation and revaluation of gold. When he raised the price from $20.67 to $35 an ounce, he set off one of the greatest overnight wealth transfers in American history. Gold, inert, ancient, untouched by machines or markets, had risen when everything else collapsed. 2 positions had survived, but a 3rd was forming. Even as the Great Depression ravaged the nation, the foundations of American industry did not disappear. They weakened, they cracked, they suffered, but they remained. And years later, as war production and innovation reshaped the economy, the companies that would form the S&P 500 began their march upward. From the ashes of 1929 to the prosperity of the 1950s and 60s, they would deliver decades of compounding growth. Cash, gold, American enterprise. 3 pillars in the ruins. Fast forward. 1973. Oil shocks, inflation spiraling out of control, interest rates choking the economy. The dollar plunges. Savers watch their money lose value month after month. The stock market stagnates for a decade. But again, the pattern resurfaces. Gold, unloved for decades, rises 24x. Cash, short-term bills, protects purchasing power when nothing else does. And the companies inside the S&P 500, though battered, survived long enough to launch the greatest bull run in human history, starting in 1982. Then comes 2008, the most violent financial collapse since the Great Depression. Housing falls apart. Banks implode. Markets drop 57%. But once more, the three positions endure. Cash gives Buffett the ammunition to rescue Goldman and GE. Gold surges as central banks flood the world with money. The S&P 500, after a brutal decline, recovers and then rises 400% over the next decade. Then, 2020. A virus stops the world. Markets fall 35% in 23 days. Panic. Lockdowns. Empty streets. And yet, the pattern, unchanged. Cash becomes a weapon. Gold hits new highs. And the S&P 500 rebounds so fast it defies every economic model. What makes these three positions so enduring? What threads tie them together across nearly a century of chaos? The story you are about to witness is not just a financial analysis. It is a pattern written into the structure of modern civilization. A pattern shaped by the decisions of presidents, central bankers, CEOs, and silent hands that never appear in photographs, but leave fingerprints on every crisis we experience. In the chapters ahead, we will unravel why cash thrives in deflation, why gold thrives in inflation, why equities thrive over time despite every collapse, why these three positions reappear in every crisis cycle, and why, even today, they may be the last resilient pillars standing. As we step deeper into this documentary, the question emerges. If these three positions have endured every crisis for nearly a century, what do they reveal about the next one? The body of this film begins now. Chapter 1. The Blueprint of Survival. Why only three positions withstand a century of crises? Every financial crisis has its own personality, its own causes, victims, and consequences. Yet beneath their differences lies a repeating pattern, a cycle of deflation, inflation, and recovery. This cycle has defined every major market shock since the dawn of modern finance. And the reason cash, gold, and equities endure is because each one thrives in a different phase of that cycle. To understand this pattern, we must examine these crises not as isolated disasters, but as linked chapters in a broader story. A story of human psychology, government intervention, monetary evolution, and the resilience of productive enterprise. Across the next chapters, we will move through nearly a century of upheaval, tracing how each position performed, why it worked, and what forces made it necessary. We begin where all modern financial stories begin, with collapse. Chapter 2. Depression, 1929 to 1945. Cash becomes power ****. By the time the stock market fell 89%, America had entered a crisis far more serious than volatility. It had entered deflation, an economic disease that makes cash more valuable every month and debts more suffocating with every passing year. Prices fell 10% per year. Wages collapsed. Businesses failed not because they lacked customers, but because those customers were conserving every dollar like oxygen. In a world where banks were failing and credit evaporated, cash wasn't merely money. It was survival itself. Why cash thrived in the Depression? 1. Prices fell sharply, so every dollar bought more. 2. T-bills continued paying positive interest while everything else collapsed. 3. Liquidity was rare, giving cash holders immense bargaining power. Figures like Bernard Baruch, John Templeton, and early private investors understood this. They waited, quietly, patiently. And when assets hit unimaginable lows in 1932 to 33, they deployed their cash into the bones of American industry. Their returns in the recovery were enormous, not because they were geniuses, but because they survived long enough to buy what others were forced to sell. Gold, the unspoken player. Though gold did not trade freely during the Depression, it played a pivotal role. When Roosevelt revalued gold from $20.67 to $35, he instantly devalued the U.S. dollar by 69%. Anyone holding gold saw their wealth rise overnight. A simple truth emerged from the darkest economic years in history. Deflation crowns cash. Devaluation crowns gold. Recovery crowns equities. The template was set. Chapter 3. Inflation, 1970 to 1980. Gold becomes the lifeboat ****. If the Depression proved the power of cash, the 1970s proved the opposite. Inflation destroys cash with silent brutality. Prices doubled, then doubled again. Bonds, once considered the safest asset in America, produced negative real returns for over a decade. Every dollar saved lost value the moment it touched a bank account. And yet, amid this erosion, one asset detonated upward with historic force: gold. From $35 1970 to $850 1980, gold rose 24x in a single decade. Why the 1970s sent gold exploding upward. 1. The U.S. left the gold standard in 1971, ending dollar convertibility. 2. Oil shocks caused imported inflation and global panic. 3. Trust in the currency collapsed, and central banks printed aggressively. The result: gold became the universal escape valve. Meanwhile, cash was punished. Money market yields could not keep up with rising prices. Savers lost purchasing power faster than they could earn it. Cash, the king of the Depression, became a victim of inflation. Equities, the sleeping giant. The S&P 500 moved sideways for 14 years. But beneath the surface, something was building: technological innovation, deregulation, and baby boomer consumption. When interest rates finally peaked in 1982, pent-up corporate strength erupted. For nearly 2 decades, U.S. equities produced 17% annual returns, creating the greatest bull market ever recorded. This chapter proved a second law. Inflation crowns gold. Recovery crowns equities. Cash is punished. Once again, the pattern held. Chapter 4. The Modern Crash 2008. Liquidity becomes a weapon ****. The collapse of 2008 was different. It wasn't driven by deflation like the 1930s, nor inflation like the 1970s. It was the result of systemic leverage, a financial architecture built on invisible explosives: housing debt, derivatives, credit swaps, shadow banking. When Lehman Brothers fell, the system froze. Markets fell 57% in mere months. Banks teetered. The global financial system came close to stopping entirely. Why cash again became king. In a credit crisis, cash is not just valuable. It becomes the only functioning currency. This is why Warren Buffett's $40 billion stockpile turned into a weapon. While the world panicked, he struck deals with Goldman Sachs, GE, and Bank of America, deals regular investors could never access. Liquidity in crisis becomes opportunity. Gold, the post-crash winner. While gold initially dipped from $850 to $700, the moment the Federal Reserve began quantitative easing, a predictable mechanism activated. 1. Money printing raised inflation expectations. 2. The dollar weakened. 3. Demand for safe assets surged. Gold doubled, then nearly tripled. Equities, the Phoenix effect. The S&P 500 didn't merely recover, it erupted. From 2009 to 2020, the index produced a 400% return. This chapter proved the third rule. Credit crises crown cash. Money printing crowns gold. Recovery crowns equities. 3 crises. 3 different causes. The same 3 survivors. Chapter 5. The Global Shock, 2020. System failure in real time ****. The COVID crash was unprecedented not because markets fell, but because they fell faster than ever recorded. 35% wiped out in 23 days. Entire economies locked down. Supply chains broke. Airplanes vanished from the sky. Streets emptied. Demand collapsed overnight. And yet, within this chaos, the century-old pattern resurfaced perfectly. Cash, instant power. Investors who held cash weren't merely protected. They became predators. Bill Ackman turned $27 million into $2.6 billion with credit default swaps, then used cash to buy world-class companies at 40 to 50% discounts. Liquidity, once again, became a weapon. Gold, a direct reflection of money printing. As central banks printed $4 trillion in months, gold shot from $1,450 to $2,070, a 42% gain in a few months. Equities, the fastest recovery in history. The S&P 500 recovered in 6 months, then surged to new highs. It was the ultimate demonstration of the third mechanism. Markets rise long before the economy recovers, because markets price the future, not the present. Chapter 6, the 2022 Bear Market. A new axiom forms, ***. 2022 was defined by two forces: inflation and rate hikes. Tech stocks collapsed 70%. Crypto evaporated. Bonds suffered their worst year in 100 years. And yet, cash earned 5% in T-bills. Gold held firm despite volatility. The S&P 500 rebounded 25% in 2023. The pattern, after nearly a century, remained unbroken. Chapter 7. The Three Pillars Explained. Now we step back from history and examine the mechanisms that make these positions resilient. Position 1. Cash and Treasury bills. The asset of deflation, panic, and frozen systems. Cash works because it thrives when credit contracts. Banks fail. Asset prices fall. Liquidity vanishes. Investors panic. The mechanism is simple. When everything is forced to sell, cash is the only thing buyers want. This makes its value rise precisely when everything else collapses. Treasury bills, backed by the U.S. government, add income to that safety, making them a superior form of cash during storms. Position 2. Physical gold. The asset of inflation, devaluation, and money printing. Gold works because governments can print currency, but they cannot print gold. Inflation erodes savings. Trust in fiat money cycles collapses. Central banks use gold as a reserve against instability. Gold is not a growth asset. It is a protection asset, thriving when currencies lose credibility. Position 3. The S&P 500. The asset of growth, innovation, and human productivity. Equities work because capitalism produces innovation. Corporate earnings grow over time. Markets recover after shocks. Recessions are temporary. Productivity increases across generations. The S&P 500 is a bet not on America's government, but on its companies: Apple, Microsoft, Amazon, Google, JP Morgan, Exxon, and hundreds more. Over any 15-year period in history, the S&P 500 has never produced a negative return. It always recovers. It always compounds. Chapter 8. The Cycle Revealed. Let us now return to the grand pattern. Deflation, cash wins. 1929-2008. Inflation, gold wins. 1970s, 2022. Recovery, equities win. 1950s, 60s, 1980 to 2000, 2009 to 2021. This is the foundational mechanism of economic survival. When the world panics, cash rises. When governments panic, gold rises. When the world stabilizes, stocks rise. No other assets cover all three phases. This is why these three positions endured every crisis. Chapter 9. The Resurgence of the Pattern Today. Buffett holds $325 billion in cash, the most in Berkshire history. Central banks bought 1,000 plus tons of gold annually for 3 straight years. And U.S. equities continue compounding despite volatility. The century-old pattern is active right now, which leads to a question. Is the world moving toward deflation, inflation, a credit crisis, a recovery? No one knows. But history offers one truth. No matter which crisis comes next, one of these three assets always becomes the lifeboat. The pattern endures, and its next chapter is already forming. In the end, after crossing 96 years of history, after walking through the wreckage of collapsed banks, shuttered factories, broken governments, and rewritten economic rules, one truth stands unmistakably clear. Only a handful of positions, 3 to be exact, endured everything the world threw at them. They survived the unthinkable. They adapted when systems froze. They re-emerged when entire nations questioned whether tomorrow would arrive. And as we close this documentary, we're left with a question more haunting than any recession, more relevant than any data chart, more urgent than any economist's forecast. What does survival actually mean in a world designed to collapse? A century in review. From the cold morning of October 29, 1929, to the boarded-up banks of 1933, to the ration books of World War II, from the oil shocks of the 1970s, to inflation roaring at double digits, to interest rates hitting 20%, from the dot-com implosion, to the subprime avalanche of 2008, to the silent streets of 2020. Every era believed its crisis was unprecedented. Every generation insisted, this time is different. And every time, history proved them wrong. Because the pattern never changed. The cycle never broke. The mechanisms stayed the same. Boom. Debt. Excess. Collapse. Reset. Rebuild. And through each reset, power quietly flowed toward the same three positions. Positions that never screamed, never panicked, never needed headlines. They simply endured. The lesson hidden in the crashes. As we revisited each era, a deeper pattern emerged, one no classroom teaches, no politician admits, and no newspaper prints on its front page. Systems fall. Strategies survive. But positions endure. The nature of these positions, whether capital structures, ownership models, or institutional footholds, didn't matter as much as their underlying design. They were built to outlast storms. Not to win headlines. Not to spike in value overnight. Not to promise quick rewards. But to persist. And that is the quiet brilliance behind their survival. They were engineered, not for speed, but for resilience. Across every crisis, the same outcome. When households collapsed under debt. When companies vanished from stock exchanges. When governments rewrote their currencies. When banks folded into each other like dominoes. These three positions remained intact. It didn't matter who ran the White House. It didn't matter what new policy was announced. It didn't matter which conflict erupted, which currency weakened, which market burned. The positions outlived the news cycle. They outlived the fear. They outlived the collapse. And here is the paradox. Most people lost wealth during crises because they held things designed to perform only during good times. But the positions that endured were built specifically for the bad times. They existed in the shadows of the system, quietly absorbing the failures of everything else. Modern relevance. Why this matters today. This story doesn't end in 1929, or 1971, or 2008, or even 2020. Because right now, today, you are living inside another turning point. Debt levels have surpassed every historical record. Currencies are weakening under invisible pressure. Nations are whispering about recession. Banking systems are tightening quietly. And inflation still lingers like smoke after a fire. We don't know which event will trigger the next crisis. A credit freeze. A sovereign default. A sudden geopolitical shock. A banking miscalculation. A chain reaction we never saw coming. But history has made one thing certain. Something always comes. And when it does, only some positions endure. The same cycle that rewrote the 20th century is preparing to write the next chapter of the 21st. And whether we realize it or not, we are all characters inside that chapter. What the three survivors teach us. Across the decades, their message is the same. Endurance is not luck. It is structure. It is design. It is intent. These positions were built on ownership, not speculation. Scarcity, not promises. Control, not exposure. Utility, not excitement. Long-term structure, not short-term gain. They didn't grow the fastest. They didn't attract the crowds. They didn't dominate the conversations of their time. But when markets burned to ash, they were the ones left standing on day 7. They teach us that survival is a strategy, that resilience is a choice, that the future belongs not to those who predict perfectly, but to those who structure intelligently. The hidden continuity of power. The deeper revelation is this. The same groups who dominated the aftermath of 1929 were the ones positioned for the inflationary 1970s, and the ones who emerged stronger after 2008, and the ones who quietly expanded during COVID. Crises didn't weaken them. Crises fed them. Because they understood something the rest of the world forgot. Every collapse transfers power. Every panic reveals the unprepared. Every crisis is a redistribution event. And those who held the three enduring positions didn't just survive history, they shaped it. As we close, as the final images fade, as the archives return to darkness, as the last words of this chapter fall into silence, one truth remains, echoing across nearly a century. The world changes. The cycles repeat. The systems fail. But the positions that endure never disappear. They wait. They watch. They outlast. And the question left to you, the viewer, the reader, the participant in the next turning, is simple, almost haunting. When the next crisis arrives, which position will you be standing in? Because history has already answered everything else.